Question 1. The risk matrix shows a client in California with a moderate risk tolerance and a long-term investment horizon. The client has expressed interest in understanding the different account types available at your firm, specifically inquiring about the implications of opening a cash account versus a margin account for their planned investments in municipal bonds and corporate stocks. Which of the following represents the most appropriate initial response to the client's inquiry? Option A. Explain the mechanics of a margin account, highlighting its potential for increased purchasing power, and then briefly mention that a cash account is also available for simpler transactions. Option B. Provide a general overview of account types without delving into specific risks or suitability concerns, assuming the client will ask follow-up questions if they need more detailed information. Option C. Proactively inform the client about the fundamental differences between cash and margin accounts, emphasizing the specific risks and benefits of each in the context of their stated investment goals and risk tolerance, including disclosures regarding the suitability of municipal bonds in margin accounts and the amplified risks of margin trading in corporate stocks. Option D. Focus on the potential benefits of margin trading, such as leveraging their investment, and downplay the associated risks, assuming the client's moderate risk tolerance implies an understanding of these complexities. The correct answer is C. Proactively inform the client about the fundamental differences between cash and margin accounts, emphasizing the specific risks and benefits of each in the context of their stated investment goals and risk tolerance, including disclosures regarding the suitability of municipal bonds in margin accounts and the amplified risks of margin trading in corporate stocks. Explanation. The risk matrix shows a client with a moderate risk tolerance and a long-term investment horizon. The client has expressed interest in understanding the different account types available at your firm, specifically inquiring about the implications of opening a cash account versus a margin account for their planned investments in municipal bonds and corporate stocks. This scenario is professionally challenging because it requires not only a thorough understanding of account types and their associated risks, but also the ability to clearly communicate these complex details to a client in a way that facilitates informed decision-making, all while adhering to FINRA regulations in California. The best approach involves proactively informing the client about the fundamental differences between cash and margin accounts, emphasizing the specific risks and benefits of each in the context of their stated investment goals and risk tolerance. This includes clearly disclosing that municipal bonds are generally not suitable for margin accounts due to potential liquidity issues, and that margin trading in corporate stocks carries amplified risk, including the potential for margin calls and forced liquidation. This approach aligns with FINRA Rule 2111, suitability, and the general obligation of a broker-dealer to provide fair and balanced information to customers regarding investment products and account types, ensuring the client can make an informed decision based on their individual circumstances. An incorrect approach would be to only explain the mechanics of a margin account without adequately detailing the associated risks or comparing it to a cash account, especially when the client has expressed interest in understanding different account types. Failure to provide a balanced overview and highlight specific risks, particularly concerning municipal bonds, could lead to a misunderstanding of the potential downsides and a violation of the duty to ensure suitability. Another incorrect approach would be to focus solely on the potential benefits of margin trading, such as increased purchasing power, without equally emphasizing the amplified risks, including the possibility of losing more than the initial investment and the implications of margin calls. This selective disclosure is misleading and fails to meet the regulatory requirement for providing complete and accurate information. Finally, an incorrect approach would be to assume the client understands the implications of different account types based on their stated risk tolerance and investment horizon, and therefore only provide a brief overview. This assumption bypasses the crucial step of explicit disclosure and education, leaving the client vulnerable to making decisions without full comprehension of the risks involved. Professionals should approach such situations by first understanding the client's stated needs, risk tolerance, and investment objectives. Then, they must clearly and comprehensively explain all relevant account types, including their features, benefits, and most importantly, their associated risks. This explanation should be tailored to the client's specific investments and circumstances, ensuring that the client has all the necessary information to make an informed decision that aligns with their financial goals and risk profile, thereby fulfilling their fiduciary and regulatory obligations. Question 2. The audit findings indicate that a California-based underwriter, in its role of bringing a new issue of common stock to market for a technology startup, relied heavily on the issuer's management for all information regarding the company's financial health and operational projections, and subsequently filed the registration statement with the California Department of Financial Protection and Innovation without conducting independent verification of key data points. Which of the following approaches best reflects the required professional conduct and regulatory compliance in this scenario? Option A. Prioritize marketing efforts to potential investors and gauge market interest before completing the full due diligence and filing the registration statement, believing that market demand will validate the offering. Option B. Accept the issuer's representations at face value and proceed with filing the registration statement, assuming management has acted in good faith and provided accurate information. Option C. Expedite the filing of the registration statement with the California Department of Financial Protection and Innovation, relying on the regulatory body's review process to identify and rectify any inaccuracies or omissions. Option D. Conduct comprehensive due diligence to independently verify all material information in the registration statement, including financial data, operational projections, and management's background, before filing with the California Department of Financial Protection and Innovation. Correct answer is D. Conduct comprehensive due diligence to independently verify all material information in the registration statement, including financial data, operational projections, and management's background, before filing with the California Department of Financial Protection and Innovation. Explanation: the audit findings indicate a potential breakdown in the rigorous process required for bringing new securities to market in California. This scenario is professionally challenging because it involves balancing the issuer's desire for efficient capital raising with the paramount regulatory obligation to protect investors through full and fair disclosure. A failure in this process can lead to significant legal, financial, and reputational damage for all parties involved. Careful judgment is required to ensure compliance with the California Corporate Securities Law of 1968 and related regulations. Best professional approach involves a comprehensive due diligence process that meticulously verifies all information presented in the registration statement and prospectus. This includes confirming the accuracy of financial statements, assessing the issuer's business operations, management, and the risks associated with the offering. This thorough verification is crucial for fulfilling the underwriter's duty of care and ensuring that investors receive accurate and complete information, as mandated by California securities laws and FINRA rules governing underwriters. This approach prioritizes investor protection by ensuring the integrity of the offering documents before they are disseminated to the public. An approach that relies solely on the issuer's representations without independent verification presents a significant regulatory and ethical failure. This bypasses the underwriter's fundamental responsibility to conduct due diligence, potentially leading to the dissemination of misleading or incomplete information to investors. Such an omission violates the spirit and letter of securities regulations, which require underwriters to act with diligence and good faith. Another professionally unacceptable approach would be to expedite the filing of the registration statement with the California Department of Financial Protection and Innovation, DFPI, without completing the necessary due diligence, assuming that any deficiencies will be addressed during the review period. While the DFPI does review filings, the primary responsibility for ensuring the accuracy and completeness of the initial disclosure rests with the issuer and the underwriter. Relying on the regulatory review to catch all errors is a dereliction of duty and exposes investors to undue risk. Finally, an approach that focuses primarily on marketing the securities to potential investors before the registration statement has been thoroughly reviewed and deemed adequate by the underwriter and legal counsel is also a failure. This premature marketing, often referred to as gun jumping, can violate regulations designed to prevent the solicitation of offers to buy securities before the offering is officially registered and the final prospectus is available. Professionals should employ a decision-making framework that prioritizes a systematic and thorough due diligence process. This involves establishing clear internal procedures for information gathering and verification, engaging experienced legal counsel, and maintaining open communication channels with the issuer. The focus should always be on investor protection, ensuring that all disclosures are accurate, complete, and not misleading, in strict adherence to California's regulatory framework. Question 3. Stakeholder feedback indicates a need to clarify permissible activities for a registered representative in California during the pre-filing period of a new equity offering. Which of the following actions, if taken by the representative, would be considered compliant with the Securities Act of 1933? Option A. Issuing a press release that highlights the company's strong financial performance and hints at an upcoming equity raise to fund future expansion. Option B. Engaging in private conversations with select institutional investors, providing them with preliminary financial projections, and discussing potential deal terms for the new issue. Option C. Focusing solely on internal preparation of the registration statement and prospectus, and refraining from any public statements that could be construed as an offer or solicitation related to the upcoming securities. Option D. Posting on social media about the company's exciting growth prospects, and mentioning that exciting news regarding capital raising is on the horizon. Correct answer is C. Focusing solely on internal preparation of the registration statement and prospectus, and refraining from any public statements that could be construed as an offer or solicitation related to the upcoming securities. Explanation. This scenario presents a professional challenge because it requires a registered representative to navigate the delicate balance between promoting a new offering and adhering strictly to the Securities Act of 1933 regulations regarding the pre-filing period in California. The core difficulty lies in preventing the premature dissemination of information that could be construed as an illegal offer or sale before the registration statement is effective, while still engaging in legitimate preparatory activities. Careful judgment is required to distinguish between permissible gun-jumping activities and prohibited solicitations. The best professional approach involves strictly adhering to the limitations imposed by the Securities Act of 1933 during the pre-filing period. This means refraining from any communication that could be interpreted as an offer to sell or a solicitation of an offer to buy the securities. Instead, the focus should be on internal preparation, such as drafting the registration statement and prospectus, and conducting due diligence. Any public communications must be limited to factual statements about the company's business and operations, without mentioning the upcoming offering. This approach is correct because it directly aligns with the regulatory intent of the Securities Act of 1933, which aims to protect investors by ensuring they receive comprehensive and accurate information through the prospectus once it is filed and becomes available. By avoiding any offer or sale-related communications, the representative ensures compliance and prevents potential liabilities for both themselves and the issuer. An incorrect approach would be to issue a press release that highlights the company's strong financial performance and hints at an upcoming equity raise to fund future expansion. This is a regulatory failure because it constitutes gun-jumping, an illegal offer to sell securities before the registration statement has been filed with the Securities and Exchange Commission. Such a press release, even if factual about the company's performance, becomes problematic when linked to an impending securities offering, as it can create undue excitement and influence potential investors before they have access to the legally mandated disclosure documents. Another incorrect approach would be to engage in private conversations with select institutional investors, providing them with preliminary financial projections and discussing potential deal terms for the new issue. This is a regulatory failure because it constitutes an illegal offer and solicitation of interest in a security that is not yet registered. Such private discussions bypass the public disclosure requirements of the Securities Act of 1933 and can lead to accusations of selective disclosure and unfair advantage for certain investors. A third incorrect approach would be to post on social media about the company's exciting growth prospects and mention that exciting news regarding capital raising is on the horizon. This is a regulatory failure as it constitutes a public solicitation of interest in an unregistered security. Social media platforms are considered public forums, and such a post, even if vague, can be interpreted as an attempt to generate demand for the offering before the registration process is complete, thereby violating the spirit and letter of the Securities Act of 1933. The professional reasoning framework for such situations should prioritize a thorough understanding of the Securities Act of 1933 provisions, particularly those pertaining to the pre-filing and waiting periods. Professionals must always err on the side of caution when interpreting what constitutes an offer or solicitation. When in doubt, it is imperative to consult with legal counsel or compliance departments to ensure all communications and activities are compliant. The primary ethical obligation is to protect investors by ensuring they receive all material information through the proper regulatory channels before making investment decisions. Question 4. Operational review demonstrates that a client has sent an email requesting an immediate wire transfer of funds to a new, previously unapproved beneficiary. The email provides all the necessary details for the transfer, but also expresses urgency due to a time-sensitive opportunity. Which of the following represents the most appropriate course of action for the registered representative in the state of California? Option A. Decline the wire transfer request outright, citing internal policy against new beneficiary additions via email. Option B. Contact the client via a verified phone number on file to verbally confirm the wire transfer instructions and the urgency of the request before proceeding. Option C. Immediately execute the wire transfer as requested by the client via email to meet their urgent needs. Option D. Forward the client's email request to the firm's compliance department for review without any direct client contact. The correct answer is B. Contact the client via a verified phone number on file to verbally confirm the wire transfer instructions and the urgency of the request before proceeding. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a client's direct instruction to circumvent established security protocols for a payment. The registered representative must balance the client's stated desire for expediency with their fiduciary duty and regulatory obligations to protect the client's assets and prevent fraudulent activity. Failure to properly assess and act upon such a request can lead to significant financial losses for the client, regulatory sanctions for the representative and firm, and reputational damage. The core of the challenge lies in discerning a legitimate client request from a potential attempt at unauthorized access or a misunderstanding of secure transaction processes. Correct approach analysis. The best professional practice involves immediately halting the transaction and initiating a verification process to confirm the client's identity and the legitimacy of the request. This approach prioritizes security and regulatory compliance. Specifically, the representative should contact the client through a pre-established secure channel, e.g., a phone number on file, not one provided in the email, to verbally confirm the instructions. This direct, authenticated communication is crucial for verifying the client's intent and ensuring that the email was not compromised or sent under duress. This aligns with FINRA Rule 2150, Communications with the Public, and general principles of safeguarding client assets, which require due diligence and verification to prevent unauthorized transactions and potential fraud. It also reflects the ethical obligation to act in the client's best interest, which includes protecting them from financial harm. Incorrect approaches analysis. One incorrect approach involves proceeding with the payment as requested via email, assuming the client's instruction is valid. This is a significant regulatory and ethical failure because it bypasses essential security measures designed to protect client funds. It exposes the client to the risk of unauthorized access and potential fraud if the email account has been compromised. This action violates the principle of safeguarding client assets and could be seen as facilitating a potentially fraudulent transaction, leading to severe disciplinary action. Another incorrect approach is to simply refuse the request without further investigation or explanation. While caution is warranted, a complete refusal without attempting to verify the client's intent or explain the security protocols can be seen as poor customer service and a failure to adequately assist the client. It doesn't address the underlying reason for the client's request for expediency and misses an opportunity to educate the client on secure practices. A third incorrect approach is to forward the request to a supervisor without taking any immediate steps to verify the client's identity or the legitimacy of the instruction. While escalation is sometimes necessary, the representative has a direct responsibility to ensure the security of client transactions. Delegating the entire verification process without initial due diligence is insufficient and can delay a necessary security check, potentially allowing a fraudulent transaction to proceed. Professional reasoning. Professionals should approach such situations with a risk-based mindset. The primary risk is the compromise of client assets. Therefore, the decision-making process must prioritize security and verification. When a request deviates from standard operating procedures, especially concerning financial transactions, the immediate step should be to authenticate the request through a secure, pre-established channel. If authentication is successful, the representative can then proceed with explaining the standard procedures and any associated timelines. If authentication fails or raises further concerns, the situation warrants immediate escalation to the appropriate compliance or supervisory personnel. The goal is to protect the client and the firm while maintaining a professional and responsive client relationship. Question 5. Stakeholder feedback indicates a registered representative in California is preparing to present information about collateralized mortgage obligations, CMO, to a group of potential investors. What approach should the representative prioritize to ensure compliance with FINRA regulations and ethical standards when discussing CMOs? Option A. Focus on the potential for capital appreciation and income generation, while briefly mentioning that some risks exist without elaborating on specific risks like interest rate volatility or prepayment uncertainty. Option B. Provide a balanced overview of CMOs, detailing their structure, including different tranches and their sensitivity to interest rate and prepayment changes, while clearly articulating the associated risks such as interest rate risk and prepayment risk. Option C. Describe CMOs as a secure investment option that provides stable income and capital preservation, suitable for all types of investors seeking low-risk opportunities. Option D. Emphasize the potential for higher yields and income generation offered by CMOs, highlighting their benefits as a way to enhance portfolio returns. The correct answer is B. Provide a balanced overview of CMOs, detailing their structure, including different tranches and their sensitivity to interest rate and prepayment changes, while clearly articulating the associated risks such as interest rate risk and prepayment risk. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to communicate complex financial products, specifically collateralized mortgage obligations, CMO, to the public in a manner that is both informative and compliant with FINRA rules in California. The inherent complexity of CMOs, with their various tranches and prepayment risks, necessitates careful consideration of how to present this information without misleading potential investors. The representative must balance the need to explain the product's features and risks with the regulatory obligation to ensure communications are fair, balanced, and not promissory. Correct approach analysis. The best professional practice involves providing a balanced overview of CMOs, clearly outlining both potential benefits and significant risks. This approach aligns with FINRA Rule 2210, Communications with the Public, and the specific guidance regarding complex products. By detailing the structure of CMOs, including the concept of tranches and their varying sensitivities to interest rate changes and prepayment speeds, and explicitly stating the associated risks such as interest rate risk and prepayment risk, the representative ensures the communication is fair and balanced. This fulfills the regulatory requirement to present a comprehensive picture, enabling potential investors to make informed decisions. Incorrect approach is analysis. Presenting CMOs solely as a way to achieve higher yields without adequately disclosing the associated risks of principal and interest payment volatility due to prepayment and interest rate fluctuations is a regulatory failure. This omits crucial risk disclosures required by FINRA Rule 2210, making the communication misleading and unbalanced. Focusing only on the potential for capital appreciation and income generation, while downplaying or omitting the substantial risks, such as the impact of changing interest rates on the value of the investment and the uncertainty of cash flows, is also a violation. This selective presentation creates an overly optimistic and incomplete picture, failing to meet the standards of fair dealing and balanced disclosure. Describing CMOs as a safe or guaranteed investment without any qualification is fundamentally misleading and a direct violation of FINRA rules against making unfounded claims. CMOs are subject to market risks and are not guaranteed. Such a statement would be considered an exaggerated or misleading representation, failing to provide a fair and balanced view of the investment. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes investor protection and regulatory compliance. This involves 1. understanding the product's complexity and inherent risks thoroughly. 2. Identifying all applicable regulatory requirements for communications about that product. 3. Crafting communications that are fair, balanced, and provide a complete picture, including both potential benefits and all material risks. 4. Reviewing communications to ensure they are not misleading, exaggerated, or promissory. 5. Seeking guidance from compliance departments when in doubt about the appropriateness of any communication. Question 6. Strategic planning requires a registered representative in California to facilitate the resale of restricted securities by an affiliate of the issuer. The affiliate claims to have held the securities for the minimum required period under federal regulations and asserts that the issuer has adequate current public information available. What is the most prudent and compliant course of action for the representative to ensure adherence to both federal and California state securities laws? Option A. Proceed with the sale, relying on the affiliate's assurance regarding the holding period and public information, as Federal Rule 144 compliance is generally sufficient for such resales. Option B. Focus solely on Federal Rule 144 requirements, assuming that California state securities laws will not impose additional notification or filing obligations for this type of transaction. Option C. Verify the issuer's compliance with public information requirements, confirm the affiliate's adherence to Rule 144 holding periods, and ensure all disclosures required by federal law and California's Corporate Securities Law of 1968 are made to potential purchasers. Option D. Inform potential purchasers that the securities are restricted and may have resale limitations, but proceed with the sale without independently verifying the issuer's public information or the affiliate's holding period. Correct answer is C. Verify the issuer's compliance with public information requirements, confirm the affiliate's adherence to Rule 144 holding periods, and ensure all disclosures required by federal law and California's Corporate Securities Law of 1968 are made to potential purchasers. Explanation: this scenario presents a professional challenge because it requires a registered representative to navigate the complex notification requirements under the Securities Act of 1933, specifically concerning the resale of restricted securities by affiliates of the issuer in California. The core difficulty lies in ensuring compliance with both federal and state regulations, which often have overlapping but distinct requirements. A failure to properly notify can lead to significant legal and regulatory repercussions for both the representative and their firm, including potential rescission, rights for purchasers, and disciplinary actions. Careful judgment is required to identify the precise information that must be disclosed and the appropriate timing of that disclosure. The correct approach involves proactively identifying the nature of the securities being offered and the status of the seller. When an affiliate of an issuer, who is considered an insider under SEC Rule 144, intends to resell restricted securities, specific disclosure obligations arise. This includes ensuring that the seller is aware of and complies with the holding period requirements, the availability of adequate current public information about the issuer, and the manner of sale limitations. Crucially, for sales occurring within California, the representative must also be mindful of any additional state-specific disclosure or filing requirements that might supplement federal rules. Therefore, the best professional practice is to meticulously review the transaction details, confirm the issuer's compliance with public information requirements, verify the affiliate's adherence to Rule 144 holding periods, and ensure that all necessary disclosures are made to potential purchasers in accordance with both federal regulations and California state securities laws, the Corporate Securities Law of 1968. This comprehensive approach minimizes the risk of noncompliance. An incorrect approach would be to assume that Federal Rule 144 compliance is sufficient without considering state-specific regulations. This overlooks the fact that California, like many states, has its own securities laws that may impose additional notification or filing requirements for the sale of restricted securities, even if those sales are made in compliance with federal rules. Failing to investigate and adhere to these state-level obligations constitutes a regulatory failure. Another incorrect approach is to proceed with the sale based solely on the affiliate's assertion that they have held the securities for the required period, without independently verifying the availability of adequate current public information about the issuer. Rule 144 requires that such information be publicly available. Relying solely on the seller's word without due diligence on this critical aspect is a breach of professional responsibility and a violation of the rule's intent. A further incorrect approach is to neglect to inform potential purchasers about the restricted nature of the securities and any limitations on their resale, even if all other technical requirements of Rule 144 are met. Failing to provide adequate disclosure to buyers about the status of the securities and potential resale restrictions is an ethical and regulatory lapse, potentially exposing purchasers to unforeseen risks. The professional decision-making process for similar situations should begin with a thorough understanding of the transaction's context, including the type of security, the issuer's status, and the seller's relationship to the issuer. This should be followed by a detailed review of applicable federal regulations, such as SEC Rule 144, and relevant state securities laws, in this case, California's Corporate Securities Law of 1968. The representative must then proactively confirm that all conditions for the resale are met and that all necessary disclosures are made to all parties involved, ensuring transparency and compliance at both federal and state levels. Question 7. Governance review demonstrates that a registered representative in California has a client who, due to recent market fluctuations, is expressing an urgent need to move a significant portion of their portfolio into highly liquid investments. The representative needs to decide how to best address this client's request. Which of the following approaches best aligns with regulatory requirements and professional ethics? Option A. Engage in a detailed conversation to understand the root cause of the client's liquidity concern, assess their overall financial situation, risk tolerance, and long-term objectives, and then present suitable investment options that meet these criteria. Option B. Immediately recommend a money market fund for the entire amount the client wishes to liquidate, as this product offers the highest degree of liquidity. Option C. Suggest a high-yield corporate bond fund that offers slightly better returns than a money market fund, explaining that it still provides relatively good liquidity. Option D. Advise the client to sell all their current holdings and hold the cash in a brokerage account until market conditions stabilize, without further discussion of alternative investment strategies. The correct answer is A. Engage in a detailed conversation to understand the root cause of the client's liquidity concern, assess their overall financial situation, risk tolerance, and long-term objectives, and then present suitable investment options that meet these criteria. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a registered representative to balance the client's stated desire for immediate liquidity with the potential long-term implications of their investment choices. The representative must navigate the client's emotional state, which may be influenced by recent market volatility, and ensure that any recommendation aligns with the client's overall financial goals and risk tolerance, as well as regulatory requirements in California. Failure to do so could lead to unsuitable recommendations, client dissatisfaction, and potential regulatory action. Correct approach analysis. The best approach involves a thorough, client-centric review that prioritizes understanding the client's underlying needs and objectives before suggesting any product. This means engaging in a detailed discussion to ascertain the true reason for the desire for liquidity, exploring the client's broader financial picture, including their risk tolerance, time horizon, and existing portfolio, and then presenting suitable investment options that meet these criteria. This aligns with FINRA Rule 2111, Suitability, and the California Corporations Code, which mandate that recommendations must be suitable for the customer based on their investment objectives, financial situation, and needs. It emphasizes a fiduciary-like duty to act in the client's best interest. Incorrect approach is analysis. Suggesting a specific product, such as a money market fund, without a comprehensive understanding of the client's situation, even if it offers liquidity, fails to address the potential for opportunity cost or whether it truly aligns with their long-term goals. This approach risks making a recommendation based on a superficial understanding of the client's needs, potentially violating suitability rules. Recommending a complex, high-fee product solely because it offers liquidity, without considering the client's risk tolerance or the product's suitability, is ethically questionable and likely violates suitability requirements. It prioritizes product placement over client well-being, focusing solely on the client's immediate request for liquidity, without exploring the underlying reasons or broader financial context, neglects the holistic nature of financial planning and the representative's duty to provide comprehensive advice. This can lead to short-sighted decisions that may not serve the client's best interests in the long run. Professional reasoning. Professionals should employ a structured decision-making framework that begins with active listening and in-depth discovery. This involves asking probing questions to uncover the why behind a client's request. Following discovery, the representative should analyze the gathered information against the client's established profile and then present a range of suitable options, clearly explaining the risks and benefits of each. This process ensures that recommendations are not only compliant, but also genuinely beneficial to the client. Question 8. Compliance review shows that a U.S.-based investment banking firm is structuring the compensation for an upcoming initial public offering, IPO, in California. The firm proposes to include a substantial market development fee within the underwriter's spread, which is not clearly defined by specific activities or quantifiable metrics. Which of the following approaches best reflects the compliant and ethical determination of the underwriter's compensation in this scenario? Option A. Clearly define and disclose all components of the underwriter's spread, ensuring each element, such as selling concessions, management fees, and risk allowances, is reasonable and directly tied to legitimate underwriting services and expenses, in accordance with SEC and FINRA regulations. Option B. Include a significant market development fee within the spread, justifying it as a general incentive for the firm's efforts in promoting the offering, even if specific activities are not detailed. Option C. Base a large portion of the spread on a broad percentage of the offering's gross proceeds, without providing a detailed breakdown of the services rendered by the underwriting syndicate. Option D. Allocate a substantial portion of the spread to consulting services provided by the underwriter before the underwriting agreement was finalized, without clearly distinguishing these from standard underwriting functions. The correct answer is A. Clearly define and disclose all components of the underwriter's spread, ensuring each element, such as selling concessions, management fees, and risk allowances, is reasonable and directly tied to legitimate underwriting services and expenses, in accordance with SEC and FINRA regulations. Explanation. Scenario analysis. This scenario presents a common challenge in the securities industry, where underwriters must balance their compensation with the need to ensure fair pricing for investors and compliance with regulatory requirements. The determination of an underwriter's spread is a critical component of the pricing process, and any deviation from ethical and regulatory standards can lead to significant legal and reputational consequences. The challenge lies in understanding the various components of the spread and ensuring they reflect legitimate services rendered, rather than excessive profit or an attempt to manipulate the offering price. Correct approach analysis. The best professional practice involves a thorough understanding and transparent disclosure of all components that constitute the underwriter's spread. This includes identifying legitimate expenses such as selling concessions, management fees, and risk-bearing allowances. The justification for each component must be reasonable and directly related to the services provided by the underwriter in bringing the security to market. In the United States, the Securities Act of 1933 and the Securities Exchange Act of 1934, along with FINRA rules, govern these practices. FINRA Rule 5110, for instance, requires underwriters to file underwriting agreements and related documents for review, ensuring that compensation is fair and reasonable. Transparency in disclosing these components to both the issuer and potential investors is paramount to maintaining market integrity and investor confidence. Incorrect approaches analysis. One incorrect approach involves including a market development fee that is not clearly defined or substantiated by specific activities. This can be seen as a discretionary amount that may inflate the spread beyond what is justified by actual services, potentially violating the principle of fair compensation and leading to an artificially high offering price. Such an undefined fee could be scrutinized by regulators as an attempt to extract excessive profit, which is contrary to the spirit of fair dealing and investor protection mandated by U.S. securities laws. Another incorrect approach is to base a significant portion of the spread on a percentage of the offering's gross proceeds without a clear breakdown of the services provided. While a percentage-based spread is common, it must be demonstrably linked to the underwriting syndicate's efforts, risk, and expenses. Simply applying a broad percentage without justification can be viewed as an arbitrary charge, potentially leading to an unreasonable spread that disadvantages investors. This lack of specificity can raise red flags for regulatory bodies like the SEC and FINRA, who are tasked with ensuring that underwriting compensation is fair and reasonable. A third incorrect approach is to allocate a disproportionately large portion of the spread to consulting services that were rendered by the underwriter prior to the formal underwriting agreement. While underwriters may provide advisory services, these should be clearly delineated and compensated separately or demonstrably integrated into the overall underwriting function in a justifiable manner. If these consulting fees are essentially a way to increase the underwriter's overall compensation beyond the standard spread components without clear justification or regulatory disclosure, it can be considered an improper practice. Professional reasoning. Professionals should approach the determination of the underwriter's spread with a commitment to transparency, fairness, and regulatory compliance. This involves a detailed analysis of the services provided by the underwriting syndicate, the risks undertaken, and the expenses incurred. Any compensation must be justifiable and clearly disclosed. Professionals should consult relevant regulations, such as those outlined by the SEC and FINRA, and seek guidance when necessary to ensure that the spread is fair and reasonable. The focus should always be on the value delivered to the issuer and the protection of investors, rather than maximizing underwriter profit through ambiguous or unsubstantiated fees. Question 9. Stakeholder feedback indicates a New York Stock Exchange-listed company, Empire State Enterprises, intends to repurchase a significant number of its common shares to ensure compliance with federal securities laws and maintain market integrity. Which of the following approaches to executing this repurchase program would best align with the safe harbor provisions of Rule 10b-18 under the Securities Exchange Act of 1934? Option A. Execute repurchases primarily during the first and last 30 minutes of the trading day to capture favorable price movements, with the company's trading desk managing the overall daily volume. Option B. Designate a single registered broker-dealer to execute all repurchases. Limit purchases to one transaction per day. Avoid trading during the opening and closing minutes of the trading day, and ensure daily purchases do not exceed 25% of the average daily trading volume for the preceding 4 weeks. Option C. Engage multiple broker-dealers to execute trades throughout the day, allowing for flexibility in timing and volume, as long as the total daily repurchase volume does not exceed 25% of the average daily trading volume. Option D. Allow the company's investor relations department to coordinate with various market makers to execute repurchases, with the primary goal of supporting the stock price, without explicit volume or timing restrictions beyond general market awareness. The correct answer is B. Designate a single registered broker-dealer to execute all repurchases. Limit purchases to one transaction per day. Avoid trading during the opening and closing minutes of the trading day, and ensure daily purchases do not exceed 25% of the average daily trading volume for the preceding 4 weeks. Explanation. This scenario is professionally challenging because it requires a firm to navigate the complex rules surrounding issuer repurchases under Rule 10b-18 of the Securities Exchange Act of 1934, specifically within the context of New York Stock Exchange, NYSE, listed securities. The firm must balance the company's desire to repurchase its shares with the imperative to avoid manipulative trading practices that could artificially influence the stock price. The core of the challenge lies in ensuring that the repurchase program, while executed efficiently, does not create a false impression of market activity or price support. The best approach involves a structured and compliant repurchase plan that adheres strictly to the conditions of Rule 10b-18. This includes designating a single broker-dealer to execute all purchases, limiting purchases to one per day, and ensuring purchases are made outside of the opening and closing price determination periods. Furthermore, the daily purchase volume must not exceed 25% of the stock's average daily trading volume, ADTV, for the preceding 4 calendar weeks. This methodical execution, overseen by compliance, minimizes the risk of violating anti-manipulation provisions and ensures the repurchase program is conducted in a manner that is not deemed manipulative under SEC regulations. An incorrect approach would be to allow multiple brokers to execute trades simultaneously without strict coordination and adherence to the 25% ad TV limit across all brokers. This fragmented execution increases the likelihood of exceeding the volume threshold and can create the appearance of excessive buying pressure, potentially violating the spirit and letter of Rule 10b-18 and Section 9(a)(2) of the Securities Exchange Act of 1934, which prohibits manipulative practices. Another incorrect approach is to conduct repurchases during the opening or closing minutes of trading. These periods are critical for price discovery, and significant buying activity during these times can unduly influence the opening or closing price, creating a misleading impression of market sentiment and potentially violating Rule 10b-18 safe harbor conditions. Finally, an approach that involves the company's trading desk directly managing the timing and volume of purchases without a clear, predefined plan and oversight from a designated broker, and without strict adherence to the ad TV and single-day purchase limits, is also problematic. This lack of structured execution and oversight increases the risk of unintentional manipulation and failure to meet the safe harbor requirements of Rule 10b-18. Professionals should employ a decision-making framework that prioritizes regulatory compliance and market integrity. This involves 1. Thoroughly understanding the specific requirements of Rule 10b-18 and any applicable exchange rules, like NYSE rules. 2. Developing a detailed repurchase plan that explicitly addresses all safe harbor conditions, single broker, timing, volume limits. 3. Establishing robust internal controls and compliance oversight to monitor the execution of the plan. 4. Regularly reviewing the plan and its execution to ensure ongoing compliance and to adapt to changing market conditions or regulatory interpretations. Question 10. Operational review demonstrates that a registered representative in California, who is Series 7 qualified, is developing a strategy to contact potential new clients. The representative has identified a list of 100 individuals who have recently inquired about retirement planning services through a third-party lead generation service. The representative calculates that if 10% of these individuals become clients and invest an average of $50,000, the potential commission generated would be approximately $1,500 per client, totaling $15,000 for the group. The representative is considering how to best approach these individuals. Which of the following approaches best aligns with FINRA regulations and ethical best practices for contacting potential customers in California? Option A. Initiate contact by sending a personalized email introducing the firm's retirement planning services, offering a complimentary initial consultation to discuss their specific needs, and including a link to the firm's website for more information, without mentioning specific commission figures or investment performance. Option B. Send a direct mail piece highlighting the highest performing investment products the firm offers, suggesting that these products are ideal for individuals seeking to maximize their retirement savings, and including a disclaimer about past performance not guaranteeing future results. Option C. Contact each individual by telephone, emphasizing the potential commission of $1,500 per client if they invest $50,000, and suggesting that this represents a significant opportunity for them to grow their retirement funds. Option D. Call each individual immediately, stating that based on their inquiry, they are likely to achieve a 7% annual return on their investments, and that the representative can help them reach their retirement goals quickly. The correct answer is A. Initiate contact by sending a personalized email introducing the firm's retirement planning services, offering a complimentary initial consultation to discuss their specific needs, and including a link to the firm's website for more information, without mentioning specific commission figures or investment performance. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to balance the need to generate new business with strict adherence to FINRA rules regarding communication with the public and customer suitability. The representative must ensure that any outreach is not only effective, but also compliant, avoiding misrepresentations or unsuitable recommendations, especially when dealing with potentially unsophisticated investors. The calculation of potential commission adds a layer of complexity, as it could inadvertently influence the representative's approach if not handled with strict ethical boundaries. Correct approach analysis. The best professional practice involves a systematic and compliant approach to prospecting. This includes identifying potential clients based on reasonable demographic or financial indicators that suggest a potential need for investment services, and then initiating contact in a manner that is informative and non-coercive. For example, a representative might research publicly available information or utilize a purchased, compliant list of individuals who have expressed interest in financial planning. The initial contact should clearly identify the representative and their firm, state the purpose of the call, and offer to provide further information without making any specific investment recommendations or guarantees of return. The calculation of potential commission should be a secondary consideration, used for internal business planning rather than as a primary driver for client selection or communication strategy. This approach aligns with FINRA Rule 1010, Communications with the Public, and the general principles of suitability, ensuring that customer interests are prioritized. Incorrect approach is analysis. One incorrect approach involves prioritizing potential commission earnings over regulatory compliance and customer suitability. For instance, if a representative were to solely target individuals based on a high potential commission calculation, without considering their investment objectives, risk tolerance, or financial situation, this would be a direct violation of FINRA suitability rules. This approach risks making unsuitable recommendations and engaging in high-pressure sales tactics, which are prohibited. Another incorrect approach is to make specific investment recommendations or projections of returns during the initial contact, especially when based on a preliminary calculation of potential commission. This is problematic because the representative has not yet gathered sufficient information to determine if the recommended investment is suitable for the potential client. Such actions can be construed as misleading or deceptive, violating FINRA Rule 2210, Communications with the Public, and potentially leading to misrepresentation. A third incorrect approach is to use overly aggressive or misleading language to solicit business, such as guaranteeing a certain rate of return or implying that an investment is risk-free. This is a clear violation of FINRA rules against misrepresentation and can create unrealistic expectations for the potential client, leading to significant ethical and regulatory breaches. Professional reasoning. Professionals should adopt a client-centric approach, prioritizing compliance and suitability in all communications. This involves understanding the regulatory landscape, particularly FINRA rules on communications and suitability. Before initiating contact, representatives should have a clear understanding of their firm's policies and procedures for prospecting. They should also be prepared to clearly articulate the services they offer and the benefits to the client, while always being mindful of not making guarantees or misrepresentations. When calculations are involved, such as potential commission, they should be used for internal analysis and not as a basis for client selection or sales pitches. A structured approach, starting with compliant prospecting methods and moving to a thorough needs assessment before any recommendations are made, is crucial for ethical and successful client engagement. Question 11. Benchmark analysis indicates that a client in New York is interested in purchasing municipal bonds from a new issue. The municipal securities principal is aware that the preliminary official statement is available, but the client is eager to invest quickly and requests only a brief overview of the offering, stating they trust the firm's judgment. What is the most appropriate course of action for the principal to ensure compliance with SEC Rule 15C2-12? Option A. Provide the client with a copy of the preliminary official statement and explain its importance for their investment decision. Option B. Offer the client a verbal summary of the key features of the bond offering based on the principal's knowledge. Option C. Proceed with the transaction based on the client's trust and the issuer's verbal assurances. Option D. Advise the client to visit the issuer's website to find information about the bond offering. The correct answer is A. Provide the client with a copy of the preliminary official statement and explain its importance for their investment decision. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a municipal securities principal to balance the immediate needs of a client with the stringent disclosure requirements mandated by SEC Rule 15C2-12. The principal must ensure that all material information is readily available to potential investors, even when faced with pressure to expedite a transaction. Failure to adhere to these disclosure rules can lead to significant regulatory penalties and reputational damage. Correct approach analysis. The best professional practice involves ensuring that the preliminary official statement, which contains all material information regarding the municipal offering, is made available to potential investors. This approach is correct because SEC Rule 15C2-12 requires that underwriters obtain a signed agreement from the issuer to provide the final official statement to the underwriter and to any potential purchaser upon request. Furthermore, the rule mandates that the underwriter provide the preliminary official statement to any potential customer who requests it. This ensures that investors have access to the necessary information to make informed investment decisions, thereby fulfilling the spirit and letter of the disclosure regulations in New York. Incorrect approach is analysis, providing only a summary of the offering to the client, without the full preliminary official statement, is professionally unacceptable. This approach fails to meet the disclosure requirements of Rule 15C2-12, as it does not provide the investor with the comprehensive material information necessary for a thorough evaluation. It bypasses the regulatory mandate for providing the preliminary official statement, directing the client to the issuer's website without confirming the availability and completeness of the preliminary official statement, is also professionally flawed. While the website may eventually host the document, there is no guarantee that it is current, complete, or readily accessible at the time of the client's request. This shifts the burden of compliance onto the client and risks non-compliance with the underwriter's obligation to provide the document. Suggesting that the client can proceed with the investment based on verbal assurances from the issuer's representative is a severe regulatory and ethical failure. Verbal assurances do not constitute legally sufficient disclosure under Rule 15C2-12. This approach completely disregards the requirement for a written preliminary official statement and exposes both the client and the firm to significant risk. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client protection. When faced with a request for municipal securities, the first step should be to identify the relevant disclosure documents, specifically the preliminary official statement. The professional must then ensure this document is readily available and provided to the client in accordance with SEC Rule 15C2-12. If the preliminary official statement is not yet available, the transaction cannot proceed until it is obtained and disseminated. This systematic approach ensures that all material information is disclosed, protecting investors and maintaining the integrity of the municipal securities market in New York. Question 12. The control framework reveals that a registered representative in California is considering recommending a foreign security to a U.S. investor. To ensure compliance with U.S. federal securities laws, which of the following actions is the most prudent and legally sound approach to determine if the foreign security can be sold to the U.S. investor? Option A. Evaluate the foreign securities trading volume and liquidity in its primary foreign market to assess its investment merit. Option B. Confirm that the foreign security is registered with the U.S. Securities and Exchange Commission, SEC, or qualifies for a valid exemption from registration under U.S. federal securities laws. Option C. Assume the security is permissible for sale to U.S. investors because it is actively traded on a reputable foreign stock exchange. Option D. Accept the foreign issuer's assurance that the security is suitable and legally cleared for sale to U.S. investors. Correct answer is B. Confirm that the foreign security is registered with the U.S. Securities and Exchange Commission, SEC, or qualifies for a valid exemption from registration under U.S. federal securities laws. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to navigate complex U.S. securities regulations concerning the sale of foreign securities to U.S. investors. The representative must understand which foreign securities are prohibited from sale due to regulatory concerns, such as those related to unregistered offerings or those deemed to be manipulative or fraudulent. Failure to adhere to these regulations can result in severe penalties for both the representative and the firm, including fines, sanctions, and reputational damage. Careful judgment is required to distinguish between permissible and impermissible foreign securities. Correct approach analysis. The best professional practice involves diligently verifying the registration status of any foreign security with the U.S. Securities and Exchange Commission, SEC, or confirming that an exemption from registration applies under U.S. federal securities laws. This approach directly addresses the core regulatory requirement that securities offered to U.S. investors must be registered or qualify for an exemption. For instance, securities issued by foreign governments or certain international organizations may be exempt, as may be securities sold in private placements that meet specific criteria under Regulation D. This proactive verification ensures compliance with the Securities Act of 1933 and prevents the sale of unregistered or otherwise prohibited foreign securities to U.S. persons. Incorrect approach is analysis. One incorrect approach is to assume that any security traded on a foreign exchange is automatically permissible for sale to U.S. investors. This is a critical regulatory failure because foreign exchanges do not necessarily adhere to U.S. registration and disclosure requirements. U.S. investors are protected by U.S. securities laws, regardless of where the security is traded. Another incorrect approach is to rely solely on the issuer's representation that the security is suitable for U.S. investors without independent verification. While an issuer may provide information, the ultimate responsibility for ensuring compliance with U.S. securities laws rests with the broker-dealer and its registered representatives. This approach bypasses the necessary due diligence required by the SEC and relevant regulations. A further incorrect approach is to only consider the liquidity of the foreign security in its home market. Liquidity is a factor in investment decisions, but does not override the fundamental requirement for registration or exemption under U.S. securities law. A highly liquid foreign security can still be prohibited from sale to U.S. investors if it has not met U.S. regulatory standards. Professional reasoning. Professionals should adopt a risk-based approach, prioritizing regulatory compliance above all else when dealing with foreign securities. This involves a thorough understanding of the Securities Act of 1933, the Securities Exchange Act of 1934, and any relevant SEC interpretations or no-action letters pertaining to foreign offerings. When in doubt, seeking guidance from the firm's compliance department or legal counsel is paramount. The decision-making process should always begin with the question: is this security registered with the SEC or exempt from registration under U.S. law? Question 13. The efficiency study reveals that a registered representative in California is preparing a general newsletter for existing clients. The newsletter discusses the overall economic outlook for the technology sector and mentions that their firm is involved in underwriting several upcoming technology IPOs. The representative wants to include a sentence stating, "We anticipate strong investor interest in these offerings, and our firm is actively building allocations for clients." What is the most appropriate action regarding this sentence? Option A. Revise the sentence to include the names of the specific IPOs and their anticipated price ranges to provide clients with more concrete information. Option B. Remove the sentence entirely to ensure the communication remains purely informational and avoids any language that could be construed as an offer to sell or buy a security. Option C. Add a disclaimer stating that this is not an offer to sell or buy securities, but the sentence can remain to inform clients about the firm's involvement. Option D. Keep the sentence as it is a general observation about market sentiment and the firm's activities. The correct answer is B. Remove the sentence entirely to ensure the communication remains purely informational and avoids any language that could be construed as an offer to sell or buy a security. Explanation. The efficiency study reveals a common challenge for registered representatives, balancing the need to inform potential investors about new opportunities with the strict regulation surrounding communications that could be construed as a prospectus. In California, under the Securities Act of 1933 and related state regulations, any communication that offers a security for sale must meet specific requirements. The challenge lies in distinguishing between general advertising or sales literature and an actual prospectus, which carries significant legal implications if not properly filed or if it contains misleading information. The best approach involves carefully reviewing the communication to ensure it does not constitute an offer to sell or an offer to buy a security. This means avoiding language that could be interpreted as soliciting an investment, specifying terms of sale, or indicating a present intent to sell. Instead, the communication should focus on general information about the company's business, industry trends, or the representative's services, without referencing specific securities or investment opportunities. This aligns with the spirit of Rule 134 under the Securities Act of 1933, which permits certain limited tombstone ads and other communications that are not deemed prospectuses, provided they contain only factual information and do not go beyond the scope of what is permitted. The key is to remain purely informational and avoid any language that could be seen as an invitation to invest. An incorrect approach would be to include any language that could be construed as an offer to sell or buy a specific security. For instance, mentioning the name of a security, its price, or the underwriter's name in a context that suggests an investment opportunity crosses the line. This could inadvertently create an illegal offer or even a de facto prospectus, violating Section 5 of the Securities Act of 1933, which requires registration or an exemption for all offers and sales of securities. Another failure would be to omit required disclosures, such as the firm's name and contact information, or to include projections or opinions that are not supported by factual data, which could lead to misrepresentation. Furthermore, sending out a communication that is overly promotional or includes subjective statements about the potential success of an investment would also be problematic, as it moves away from factual information and towards an endorsement that could be seen as an offer. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a thorough understanding of what constitutes an offer to sell or buy under federal and state securities laws. Before disseminating any communication, representatives should ask, does this communication invite an investment or offer a specific security for sale? If the answer is even potentially yes, the communication should be revised to be purely informational or submitted for review by the firm's legal or compliance department. A conservative approach, erring on the side of caution and seeking guidance when in doubt, is always the most prudent professional strategy. Question 14. The monitoring system demonstrates a significant increase in flagged social media posts by registered representatives in California. A compliance officer is tasked with refining the system's parameters to improve accuracy and efficiency. Which of the following actions represents the most effective strategy for addressing this challenge, while adhering to FINRA Rule 3010 and SEC regulations concerning communications with the public? Option A. Prioritize the speed of customer response by reducing the number of keywords the system flags, focusing only on the most egregious terms. Option B. Implement an automated system that immediately censors any communication containing a flagged keyword without further human review. Option C. Regularly update the system's keyword lexicon and algorithms based on emerging communication trends, regulatory guidance, and internal review findings, and ensure a clear escalation protocol for compliance personnel to review flagged communications. Option D. Expand the system's keyword list to include a broader range of industry-specific terms and common slang to capture more potential violations. The correct answer is C. Regularly update the system's keyword lexicon and algorithms based on emerging communication trends, regulatory guidance, and internal review findings, and ensure a clear escalation protocol for compliance personnel to review flagged communications. Explanation. This scenario presents a common implementation challenge in compliance, ensuring that automated communication monitoring systems effectively identify and flag potential violations of FINRA Rule 3010 and SEC regulations regarding the content and dissemination of communications with the public, specifically in the context of social media. The challenge lies in balancing the need for robust oversight with the practicalities of managing a high volume of digital interactions and ensuring that the system's parameters are appropriately calibrated to detect problematic content without generating excessive false positives. The best approach involves a proactive and adaptive strategy. This includes regularly reviewing and updating the system's keyword lists and algorithms based on emerging communication trends, regulatory guidance, and internal review findings. It also necessitates a clear escalation protocol for flagged communications, ensuring that a qualified compliance professional, rather than the system alone, makes the final determination on whether a violation has occurred. This approach is correct because it directly addresses the dynamic nature of digital communications and the evolving regulatory landscape, ensuring that the monitoring system remains an effective tool for compliance rather than a static, potentially outdated mechanism. It aligns with the principle of diligent supervision required by FINRA Rule 3010, which mandates that firms establish and maintain procedures to supervise the activities of their associated persons. An approach that relies solely on a static list of keywords without regular updates is professionally unacceptable. This fails to account for new slang, industry jargon, or evolving marketing tactics that could be used to circumvent detection. It also risks missing communications that, while not containing specific keywords, convey a misleading or unsuitable message, thereby violating the spirit of regulations governing communications with the public. Another professionally unacceptable approach is to automatically deem any communication flagged by the system as a violation without human review. This bypasses the critical judgment of a compliance professional and can lead to incorrect disciplinary actions or misgenuine violations. It fails to acknowledge that automated systems can generate false positives and that context is crucial in determining the appropriateness of a communication. Finally, an approach that prioritizes speed of communication over compliance review is also flawed. While timely engagement with customers is important, it cannot come at the expense of ensuring that all public communications are fair, balanced, and not misleading, as required by SEC and FINRA rules. The potential for reputational damage and regulatory sanctions from non-compliant communications far outweighs any perceived benefit of immediate, unreviewed responses. Professionals should adopt a decision-making framework that emphasizes a layered approach to communication oversight. This involves 1. Understanding the specific regulatory requirements applicable to the firm and its communications. 2. Implementing technology that is capable of sophisticated analysis, but recognizing its limitations. 3. Establishing clear, documented procedures for human review and escalation. And 4. Committing to ongoing training and system refinement to adapt to new challenges and maintain compliance. Question 15. Governance review demonstrates that a registered representative in California, who is registered with a FINRA member firm, wishes to enhance client understanding of options trading. The representative is considering several methods to achieve this educational goal. Which of the following methods represents the most compliant and professionally sound approach to educating clients about options? Option A. Distribute a pre-written email template to clients suggesting specific options trades based on recent market trends, without prior principal review or individual client suitability assessment. Option B. Create a presentation that exclusively showcases the potential profit scenarios of various option strategies, while omitting any discussion of the inherent risks. Option C. Develop and deliver a general educational seminar on options trading strategies, focusing on explaining the mechanics, common strategies, and associated risks and potential rewards in a balanced and objective manner, ensuring all content is pre-approved by a principal. Option D. Post a social media message guaranteeing a specific option strategy will achieve a 10% return within the next month. The correct answer is C. Develop and deliver a general educational seminar on options trading strategies, focusing on explaining the mechanics, common strategies, and associated risks and potential rewards in a balanced and objective manner, ensuring all content is pre-approved by a principal. Explanation. Scenario analysis. This scenario presents a common challenge in the securities industry, where registered representatives must balance providing valuable client education with adhering to strict communication regulations. The challenge lies in ensuring that all communications, especially those involving complex financial instruments like options, are not misleading, are appropriately supervised, and do not constitute an unauthorized recommendation or guarantee of future performance. The FINRA rules governing communications with the public are designed to protect investors, and failure to comply can lead to disciplinary action, reputational damage, and client harm. Correct approach analysis. The best approach involves a registered representative preparing a general educational seminar on options trading strategies. This seminar would focus on explaining the mechanics of options, various strategies, e.g., covered calls, protective puts, and the associated risks and potential rewards in a balanced and objective manner. Crucially, the representative would ensure that the seminar content is reviewed and approved by a principal prior to dissemination, and that no specific recommendations or guarantees of profit are made. This approach aligns with FINRA Rule 2210, Communications with the Public, and the general principles of responsible investment education, emphasizing disclosure and avoiding misleading statements. The focus is on educating the client about the product and its characteristics, not on soliciting a specific transaction or predicting outcomes. Incorrect approach is analysis. One incorrect approach involves the representative creating a presentation that highlights only the potential profit scenarios of specific option strategies, omitting any discussion of the substantial risks involved. This violates FINRA Rule 2210 by being misleading and unbalanced. Failing to provide a fair and balanced picture of the investment could lead clients to make uninformed decisions based on incomplete information. Another incorrect approach is for the representative to distribute a pre-written email template to clients that suggests specific options trades based on recent market movements, without any prior principal review or customization for individual client suitability. This constitutes an unauthorized recommendation and potentially a solicitation, bypassing the required supervisory procedures and suitability obligations under FINRA Rule 2111, suitability. A third incorrect approach is for the representative to post a social media update that guarantees a specific options strategy will generate a 10% return within the next month. This is a clear violation of FINRA Rule 2210, as it makes an unfounded guarantee of future performance, which is inherently misleading and prohibited. Such a statement could lead investors to believe in a certainty of profit that does not exist in the options market. Professional reasoning. Professionals should approach client communications, particularly concerning complex products like options, with a framework that prioritizes transparency, accuracy, and regulatory compliance. This involves understanding the specific FINRA rules governing communications and advertising, as well as suitability requirements. Before disseminating any material, professionals should ask, is this communication fair and balanced? Does it avoid misleading statements or guarantees? Has it been properly reviewed and approved by a supervisor? Does it align with the client's investment objectives and risk tolerance? By adhering to this rigorous internal review process, professionals can effectively educate clients while mitigating regulatory and ethical risks. Question 16. During the evaluation of a prospective client's financial situation in California, a registered representative is discussing the potential benefits of a variable annuity. Which of the following actions best adheres to regulatory requirements for communications with the public regarding variable annuities? Option A. Provide the prospect with the variable annuity prospectus and explain that it contains essential details about the product's features, risks, and charges, encouraging them to review it thoroughly. Option B. Recommend the variable annuity as a universally beneficial investment option for all clients seeking long-term growth. Option C. Highlight the potential for tax-deferred growth and the death benefit features of the variable annuity without dwelling on the associated fees or surrender charges. Option D. Assure the prospect that the variable annuity offers the same level of safety and predictable returns as a fixed annuity. The correct answer is A. Provide the prospect with the variable annuity prospectus and explain that it contains essential details about the product's features, risks, and charges, encouraging them to review it thoroughly. Explanation. This scenario presents a common challenge for registered representatives when communicating about variable products, specifically variable annuities in California. The core difficulty lies in balancing the need to provide accurate and comprehensive information with the regulatory requirements designed to protect investors from misrepresentation and omission. Variable annuities are complex financial instruments with both investment and insurance components, and their promotion is subject to stringent rules to ensure clients understand the associated risks, fees, and surrender charges. The correct approach involves proactively providing the prospect with the variable annuity prospectus and clearly explaining that it contains crucial details about the product's features, risks, and charges. This aligns with the requirements of FINRA Rule 2210 and California insurance regulations, which mandate that communications with the public must be fair, balanced, and not misleading. The prospectus is the definitive document for disclosing all material information, and its provision and explanation are essential for informed decision-making. This approach ensures compliance by prioritizing transparency and the client's right to complete information before any commitment is made. An incorrect approach would be to focus solely on the potential benefits and growth projections of the variable annuity without mentioning the associated risks, fees, or surrender charges. This omission violates the principle of fair dealing and can be considered misleading under FINRA Rule 2210 and California law, as it presents an incomplete picture of the product. Another incorrect approach would be to state that the variable annuity is similar to a fixed annuity in terms of risk and guarantees. This is factually inaccurate and misleading, as variable annuities carry investment risk and their performance is not guaranteed in the same way as fixed annuities. Such a statement would violate the duty to provide accurate information and could lead to a client making an investment decision based on false premises. Finally, an incorrect approach would be to suggest that the variable annuity is a suitable investment for any client regardless of their financial situation or investment objectives. Variable annuities are complex products with specific suitability requirements. Recommending them without a thorough assessment of the client's needs, risk tolerance, and financial goals is a violation of both regulatory obligations and ethical conduct. Professionals should approach these situations by prioritizing transparency and investor protection. This involves a thorough understanding of the product being discussed, adherence to all disclosure requirements, and a commitment to suitability. The decision-making process should always begin with the prospect's best interests in mind, ensuring they receive all necessary information to make an informed decision, rather than focusing on sales targets or product features alone. Question 17. What factors determine whether a registered representative in California is engaging in or facilitating the use of manipulative or deceptive devices or contrivances in violation of Section 10(b) of the Securities Exchange Act of 1934 and Rule 10b-5, and presented with a client's aggressive trading strategy based on what the client claims is insider information and a coordinated effort with other investors to pump up a thinly traded stock? Option A. The client's assurance that the information is legitimate and that the trading is simply a way to capitalize on market opportunities. Option B. The fact that the stock is thinly traded, suggesting it is more susceptible to price manipulation. Option C. The potential for significant profits for both the client and the registered representative from the proposed trading strategy. Option D. A comprehensive assessment of the client's trading pattern, the nature and source of the alleged insider information, the intent behind the coordinated trading activity, and whether the information is being used to artificially influence the stock's price. The correct answer is D. A comprehensive assessment of the client's trading pattern, the nature and source of the alleged insider information, the intent behind the coordinated trading activity, and whether the information is being used to artificially influence the stock's price. Explanation. This scenario is professionally challenging because it requires a registered representative to distinguish between legitimate market activity and manipulative practices, specifically under Section 10(b) of the Securities Exchange Act of 1934 and Rule 10b-5, as interpreted by the U.S. Securities and Exchange Commission, SEC. The core difficulty lies in assessing intent and the impact of actions on market integrity, especially when dealing with potentially misleading information or coordinated efforts. Careful judgment is required to avoid facilitating or engaging in prohibited conduct. The best professional approach involves a thorough investigation of the facts and circumstances surrounding the trading activity and the information being disseminated. This includes scrutinizing the source and nature of any tips or information, assessing whether the trading activity appears to be driven by genuine investment analysis or by a desire to artificially influence the price of a security, and considering whether the information being shared is material, non-public, and potentially misleading. A registered representative must exercise due diligence to ensure that their recommendations or actions are based on sound investment principles and do not involve or facilitate manipulative or deceptive practices. This aligns with the SEC's focus on preventing fraud and manipulation in securities markets, as codified in Rule 10b-5, which prohibits any act or omission that would operate as a fraud or deceit in connection with the purchase or sale of any security. An incorrect approach would be to act solely on the basis of a perceived hot tip, without independent verification or consideration of the potential for manipulation. This fails to meet the standard of due diligence required of registered representatives and could lead to violations of Rule 10b-5 if the tip is part of a manipulative scheme. Another incorrect approach is to dismiss concerns about unusual trading patterns or potentially misleading statements simply because the client is a long-standing or high-revenue producer. Regulatory compliance and ethical conduct must always take precedence over client relationships or revenue generation. Furthermore, assuming that any trading activity that results in a profit is legitimate, regardless of the underlying information or intent, is a dangerous oversimplification that ignores the manipulative and deceptive elements that Rule 10b-5 aims to prohibit. The professional reasoning framework for such situations should involve a multi-step process. First, identify any red flags or suspicious activity. Second, gather all relevant facts and information, including the source of information, the nature of the trading, and any communications. Third, assess these facts against the requirements of Section 10b and Rule 10b-5, considering whether there is evidence of deception, manipulation, or a scheme to defraud. Fourth, consult with compliance personnel or legal counsel if there is any doubt about the propriety of the activity. Finally, act in a manner that upholds the integrity of the securities markets and protects investors. Question 18. Stakeholder feedback indicates a registered representative in California has a client who wishes to invest in a private placement. The client states the issuer is a newly formed technology company incorporated in California, and that all its founders and initial employees are California residents. The client believes this means the offering is exempt from registration under federal law. What is the most prudent course of action for the representative? Option A. Advise the client that while incorporation in California is a starting point, the representative must verify that the issuer is also doing business in California and that all purchasers will be California residents, and obtain documentation to support these facts before proceeding. Option B. Assume the offering is exempt because the issuer is incorporated in California, and focus on the client's investment goals without further inquiry into the specifics of the exemption. Option C. Recommend the client seek legal counsel to determine the exemption, as the representative cannot provide advice on such matters. Option D. Proceed with the transaction, as the client's assurance that the issuer is California-based and its founders are residents is sufficient to qualify for an intrastate offering exemption. The correct answer is A. Advise the client that while incorporation in California is a starting point, the representative must verify that the issuer is also doing business in California and that all purchasers will be California residents, and obtain documentation to support these facts before proceeding. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance the desire to facilitate a client's investment with the stringent registration requirements of the Securities Act of 1933, specifically concerning intrastate offerings. The representative must exercise careful judgment to avoid facilitating an illegal offering, which could have severe consequences for both the client and the firm. The best professional approach involves thoroughly investigating the offering's compliance with Section 3A. 11 of the Securities Act of 1933 and relevant state securities laws in California. This includes verifying that the issuer is a resident of California, doing business in California, and that all sales are made exclusively to residents of California. The representative should obtain documentation from the issuer confirming these facts and ensure that the offering materials clearly state the intrastate nature of the offering and any resale restrictions. This approach is correct because it directly addresses the core requirements of the intrastate offering exemption, ensuring that the transaction adheres to federal and state securities regulations. By proactively verifying compliance, the representative acts as a gatekeeper, protecting investors and upholding the integrity of the securities markets. An incorrect approach would be to proceed with the transaction based solely on the client's assurance that the issuer is a California-based company. This fails to acknowledge the doing business in requirement and the critical need to ensure all purchasers are California residents. Relying only on the client's word bypasses the due diligence necessary to confirm the exemption's applicability and risks facilitating an unregistered, non-exempt offering. Another incorrect approach is to assume that because the issuer is incorporated in California, the offering automatically qualifies for the intrastate exemption. This overlooks the crucial doing business in aspect, which requires substantial operational presence and activity within the state, not just legal incorporation. Furthermore, it ignores the requirement that the proceeds of the offering must be used in connection with the issuer's business in California. A further incorrect approach would be to proceed with the transaction without confirming that all purchasers are California residents, and without understanding any resale restriction. The exemption is strictly for sales to residents of the state where the issuer is located and doing business. If the securities are resold to non-residents, the exemption is lost, and the securities may be deemed unregistered. The professional reasoning process for similar situation should involve a systematic due diligence checklist for any potential exemption. This includes 1. Identifying the specific exemption being claimed. 2. Understanding all conditions and requirements of that exemption under the relevant federal and state laws, in this case, Section 3A, 11, and California state securities laws. 3. Gathering sufficient documentation from the issuer and client to verify that all conditions are met. 4. Documenting the due diligence process and the basis for believing the exemption applies. 5. Consulting with legal counsel or compliance if there is any doubt about the applicability of the exemption. Question 19. Process analysis reveals that a registered representative in Ontario, Canada, is advising a client on a newly issued corporate bond. The representative has received preliminary information about the bond, including its coupon rate, maturity date, and a unique identifier. What is the most appropriate and compliant course of action for the representative to take in Ontario, Canada, when informing the client about this new bond offering? Option A. Provide the client with only the CUSIP number and a brief verbal summary of the bond's coupon rate and maturity date, assuming the client will conduct their own research. Option B. Distribute preliminary marketing materials that highlight the bond's potential benefits without explicitly mentioning the need to review the official prospectus. Option C. Wait until the bond begins trading on the secondary market before informing the client about the new issue to ensure all market data is available. Option D. Confirm the availability of the official prospectus. Inform the client about the key features of the new bond and provide clear instructions on how to access the full prospectus and explain the significance of the CUSIP number. The correct answer is D. Confirm the availability of the official prospectus, inform the client about the key features of the new bond, and provide clear instructions on how to access the full prospectus and explain the significance of the CUSIP number. Explanation. Scenario analysis. This scenario presents a common challenge for registered representatives in Ontario, Canada, when dealing with new bond issuances. The core difficulty lies in accurately and efficiently conveying crucial information about a new bond offering to potential investors, while adhering to the regulatory requirements set forth by the Ontario Securities Commission (OSC) and the Investment Industry Regulatory Organization of Canada (IIROC). Misinterpreting or miscommunicating information related to CUSIP numbers, prospectus availability, or market data can lead to investor confusion, regulatory noncompliance, and potential financial harm to clients. The representative must balance the need for prompt information dissemination with the obligation to provide complete and accurate details. Correct approach analysis. The best professional practice involves a multifaceted approach that prioritizes regulatory compliance and investor protection. This includes immediately confirming the availability of the official prospectus, which is the primary disclosure document mandated by OSC regulations for new securities offerings. The representative should then proactively inform clients about the new issue, highlighting key details such as the issuer, coupon rate, maturity date, and any unique features. Crucially, they must also provide clear instructions on how clients can access the full prospectus, typically through the issuer's website or a regulatory filing portal, and explain the significance of the CUSIP number as a unique identifier for the security. This approach ensures that clients receive comprehensive and legally required information, enabling them to make informed investment decisions. Incorrect approaches analysis. One incorrect approach involves solely relying on preliminary marketing materials or verbal summaries without ensuring the client has access to the official prospectus. This fails to meet the OSC's requirement for providing the prospectus to potential investors in new issues, potentially misleading clients by omitting critical risk factors or terms detailed in the official document. Another flawed approach is to only provide the CUSIP number without context or access to the prospectus. While the CUSIP is a vital identifier, it offers no substantive information about the investment itself, and without the prospectus, leaves the client uninformed about the security's characteristics and risks. A third incorrect approach is to delay providing any information until the bond is trading on the secondary market. This misses the opportunity to inform clients about the new issue during its primary distribution, potentially preventing them from participating in an offering they might find attractive and failing to meet the spirit of proactive client communication regarding new investment opportunities. Professional reasoning. Professionals should adopt a systematic process when handling new issue offerings. This begins with understanding the regulatory obligations for new issues in Ontario, which invariably point to the prospectus as the definitive disclosure document. Next, the representative must identify the most effective and compliant methods for communicating this information to clients, ensuring they have the means to access the full prospectus. This proactive and compliant communication strategy, which includes providing the CUSIP number as a reference point, forms the bedrock of responsible client service and regulatory adherence. Question 20. The risk matrix shows a potential for significant investor confusion and regulatory scrutiny regarding the offering of new securities. A registered representative in California is assisting a client who has expressed strong interest in purchasing shares of a new technology company going public. The representative has provided the client with a preliminary prospectus and discussed the company's prospects. The client is eager to commit to the purchase immediately, stating they trust the representative's judgment and don't need to review the final prospectus. The representative knows the final prospectus has been filed with the SEC and is available. The offering price is set at $25 per share, and the underwriting spread is 7%. The selling group members will receive 60% of the spread. What is the best course of action for the registered representative to ensure compliance with the Securities Act of 1933 and protect the client's interests? Option A. Inform the client that while their enthusiasm is appreciated, the representative cannot accept their order until the client confirms they have received and had an opportunity to review the final prospectus. Option B. Advise the client that since the offering price is fixed and the underwriting spread is known, the client can commit now, and the representative will ensure the final prospectus is sent to them after the transaction is completed. Option C. Proceed with the sale, explaining that the preliminary prospectus contains sufficient information and the final prospectus is largely a formality for this type of offering. Option D. Accept the client's order immediately, noting their verbal confirmation of interest and trust in the representative, and arrange for prospectus delivery at a later date. The correct answer is A. Inform the client that while their enthusiasm is appreciated, the representative cannot accept their order until the client confirms they have received and had an opportunity to review the final prospectus. Explanation. The risk matrix shows a potential for significant investor confusion and regulatory scrutiny regarding the offering of new securities. This scenario is professionally challenging because it requires a registered representative to balance their duty to their client with the strict requirements of securities regulations, particularly concerning the delivery of a final prospectus and the accurate representation of offering terms. Misinterpreting or failing to adhere to these regulations can lead to severe consequences for both the client and the representative, including regulatory sanctions and reputational damage. The best professional approach involves ensuring the client has received and had an opportunity to review the final prospectus before accepting any order for the new issue. This aligns with the fundamental principle of investor protection enshrined in securities law. Specifically, under the Securities Act of 1933 in the United States, a final prospectus must be delivered to purchasers of securities in a public offering. This document contains all material information about the issuer and the offering, allowing investors to make informed decisions. By waiting for confirmation of prospectus delivery and client acknowledgement, the representative upholds their fiduciary duty and regulatory obligations, preventing potential misrepresentation or sales based on incomplete information. An incorrect approach would be to proceed with the sale based on preliminary information or a verbal assurance of interest without confirming the final prospectus has been delivered. This fails to meet the statutory requirement for prospectus delivery, potentially exposing the client to risks they are not fully aware of and violating the Securities Act of 1933. Another incorrect approach is to assume the client understands the implications of the offering based on prior discussions, without verifying they have reviewed the definitive offering document. This bypasses a critical regulatory safeguard designed to ensure transparency and informed consent. Finally, attempting to expedite the sale by downplaying the importance of the final prospectus or suggesting it is a mere formality is a serious ethical and regulatory breach. It undermines the purpose of the prospectus and demonstrates a disregard for investor protection principles. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client best interests. This involves a thorough understanding of offering documents, a commitment to timely and accurate information delivery, and a proactive approach to client education regarding their rights and the risks involved in an investment. When in doubt, seeking guidance from a supervisor or compliance department is essential.